So in this video, we're going to discuss about futures pricing and the concept of arbitrage in the futures context, and how does that ensure that the price of a future stays where it is, or the price of a future could be found. Right now, to understand that, we do need to understand what is the concept of arbitrage first. Uh, the term arbitrage essentially means that there is a possibility of making free money. When we say free money, this is essentially riskless money. So you're getting money for free, you're getting money without taking any risk for getting that money. In real life, there is rarely a situation where you would get money without taking a risk for it, especially in the investment world. In the investment world, risk will, in a sense, define what your return is going to be. If you perceive the risk to be higher from a particular instrument, you will expect a higher return there. Think of it this way: if a bank is giving loan to two entities A and B, the interest rate that the bank will charge may differ both for A and for B, and the difference in interest rate would basically be a factor of what is the perceived risk of A and B by the bank, right? So technically there is no riskless money that is available in real world. We will see how this concept defines the pricing of a particular instrument, such as futures or forwards, in the derivatives world, right? So that's what we're going to talk about. This is the topic we are looking at. We've already looked at hedging, speculation, etc. Primary usage for our understanding purpose of corporates and financial management is of futures for hedging, but we do need to understand how does the price of a future contract get arrived at, right? So let's turn the discussion towards that, and let's understand how do we arrive at the future pricing, right? Theoretically, remember, theoretically, if I'm buying rice at a price of rupees 90 per kg 2 months from now, I need to secure an enough amount of money, right? So the keyword is enough money today, so that I could invest in the risk-free rate or whatever is the interest rate at this point of time to be able to buy this at 90 rupees after 2 months. Now, assuming the monthly interest rate to be 1%, how much do I need after? So this is time t equals to 0. This is time t equals to 1 month. This is time t equals to 2 months. I need 90 rupees here. If I am the buyer in our earlier contract, I need rupees 90 here. Now, assuming a monthly interest rate of 1%, this, remember, is the future value. I need to find the present value of this 90 2 months ago. If I have this amount of money, the PV of 90 today, then this invested at 1% for 2 months should give me 90 rupees. And that should ensure that I will be able to honor the contract, right? So how do I find the present value of 90? That's straightforward. I take the future value and divide by, so future value divided by 1 plus r raised to the power time. Monthly interest rate is 1%. Remember the compounding principle? Based on the compounding frequency, we derive at the monthly interest rate and then just take it to the power of whatever number of interest periods are there, right? This would work out to be rupees 88.22. Right? So if I have rupees 88.22 today and I can invest it at monthly intervals of invest this for monthly interest rate of 1%, I should be able to buy rice at 90 rupees a kg 2 months from now, right? So the money I need to ensure that I can buy the contract is 88.22, right? 88.22 when multiplied by 1 plus r to the power 2 months will give me 90, right? Now, the concept of how much interest you will be getting on this money, or how much money do you need to have it here, this rate r is commonly referred to as cost of carry in this case. Why? Is because you're carrying this money for that period, right? Now, that's the premise of how the futures pricing or forwards pricing works. Now, let's understand this concept in a little bit more detail. Let's generalize it now. So if the price of Infosys shares today is 1000 and you find that interest rate to borrow money in the market is 8%, then the 1 year future contract, 1 year, remember, future contract should trade at the future value of this money. Now we're looking at 1 year and we're looking at future price is current price, which is 1000 into 1 plus 8%. That's the annual rate raised to the power t. That's the multiplication factor. That should be the price of the future contract on Infosys. If this does not hold for some reason, whatever reason it does not hold for, there is some free money on the table to be made, right? So if this principle, this would work out to 1080. If 1080 does not hold, then there is a possibility that you will make riskless money. Let's see how. Right, so we will have to kind of decode it, understand it as we go along, that if this contract price formula does not hold, how does arbitrage come into the picture? Assume that the price of Infosys shares today is 1000. Now we are in a market and there are two, and so today's price is given as rupees 1000, and we are saying there are two parties, A and B, who are willing to get into a future contract of rupees 1100, which means A says that A will buy Infosys from B at 1100. This is the guy who's buying the future. This is the guy who's selling the future contract, which means they are agreeing that they will transact Infosys at 1100. That's the market rate of the future contract. So we are saying the future price is rupees 1100. What do we see the interest rate? The interest rate in the market is 8%, right? Now, if you buy this contract today at 1100, you could buy the Infosys share at 1100 1 year from now. If someone sells this contract today, she could sell the share at 1100 1 year from now. Look at the position of A and B. A will be able to buy at 1100, B will be able to sell at 1100 1 year from now. As per our theoretical questioning or the formula, the pricing should not have been 1100. What should that price have been? As per our theoretical construct, the pricing should have been 1080. So theoretical price of the contract is 1080. Actual price, what do we observe the actual price? That's 1100. Right? Now actual price is higher than the theoretical price, right? Typically in the context of arbitrage, remember the concept that the higher priced instrument is to be sold. Right? Now let us see if free money can be made. Right? So we'll try and understand how free money can be made. We are saying that the spot price is at 1000. That's the current price of Infosys. We are saying that the future price is at 1100. Now either one of these, theoretically speaking, as per our formula, is wrong. If this is 1000, the future price should be 1080, and if this is 1100, the future price should be slightly higher. This probably will be 1120 or somewhere around that, approximately 1020, sorry, approximately 1020 or something around that. That should be the scenario. One of them is wrong, and logically the lower priced one should go higher and the higher priced one should go lower, right? So how do we make free money? Now what is the higher price instrument? That's the future. So what are we going to do? We're going to sell this and we're going to buy this. Let's see how, right? So what do? Is we sell one future contract at rupees 1100. Remember, this is time 0 and this is time 1. This is the time for the future contract. This is where we are selling. So we are selling the future contract at 1100, which means we will be able to sell Infosys at 1100 here, right? This is just a simple contract. I've entered into a contract. So in this case, there is no cash flow, right? There is no cash flow that has happened. We have just entered into a contract, which is like a bet. We are saying 1 year from now, this contract will kind of get executed, right? Now, so that's the, remember in our discussion, we are saying the spot price or the current price is lower. So we have to buy the spot price and we have to sell the future price because that's higher. So we have sold the future price. That's taken care of. Now we want to buy the spot price, which is I have to buy one share of Infosys with rupees 1000, but I don't have 1000. So I need to borrow this 1000 first. So once I've sold this, I will borrow rupees 1000. That's a cash inflow of 1000 and the going interest rate in the market is 8%. So effectively what it means is that at time 1, there is a minus 1080 payment that is going to come. I have to pay this money back, right? That's going to come surely. Minus 1080 at time t, which is 1, right? I get plus 1000 from this step 2 by borrowing the money. Now I buy the share of Infosys. So I buy the share of Infosys at 1000, which takes out this 1000 from my account today. So 3 steps. Sell the future contract at 1100, which means you can sell Infosys at time t here. Borrow rupees 1000. So that's the borrowing we have done. Borrow rupees 1000. That will ensure that you have to pay 1080 at the end of 1 year. That's because the interest rate defined today is 8%. And buy one share of Infosys with this 1000 today, right? That's the context that we have had. Now, if I have one share of Infosys, I can sell it here. That's all I needed to ensure. Whatever happens to the price of Infosys, I don't care. Correct? If the price of Infi goes up, if the price of Infi goes down, I am already into a contract that I can sell this at 1100. And remember, this is a future, so the exchange will ensure that there is no default risk. I'm assuming at this point of time there is no default risk, even if it was a forward, right? So at the end of 1 year, I have to sell the future of sell Infosys stock at 1100. I already have that stock, right? So nothing else that I need to do. All I need to do is hold the share or stock for 1 year and then execute the contract. That will get executed any which ways. That's binding because two parties have entered into that agreement that at the end of 1 year, I will be selling Infosys at 1100, right? So what happens at the end of 1 year? At the end of 1 year, so let's draw the timeline again. I got 1000, which went out to buy the share. At the end of 1 year, the future contract matures. So I sell this one share of Infosys at 1100. I get plus 1100. I return 1080 to the bank, right? I return this 1080 to the bank. So this is repay. This is future payoff, right? So I get this money here. What is the amount I make? That's plus 20. This 20 is riskless money. I have basically ensured that I will make this 20 today, right? Or I have ensured it today that I will make this 20 at the end of 1 year. There is no discrepancy in this because whatever happens to Infosys price in the market is immaterial. Even if the price is 800 or the price is 1800, I don't care because I will be selling it at 1100. That was what the contract was, right? So I will be able to sell one share of Infosys at 1100. I will be able to return the bank money because that's also fixed, 8% fixed interest component, and I'll be able to retain 20 as riskless profit, right? This is known as arbitrage, which is riskless money. In real markets, this cannot exist. Why? Is because the moment markets spot it, people will buy Infosys share which will pick up the demand for Infosys share, which will take this price higher from 1000. People will sell Infosys future, which will reduce the demand and increase the supply for Infosys future, which will reduce the price till such time that the equation holds, till such time that the equation of 1000 into 1 plus R, or I shouldn't say 1000 because that might go up, spot price into 1 plus R raised to the power 1 is going to be equal to the future price. Till such time this equation holds, people will kind of move in very quickly to close this arbitrage as soon as possible, because everyone would ideally want to make free money. Even if there is 1 rupee free money available, even if this was trading at 1081, the future was trading at 1081, there is rupees 1 of free money available. Why would you leave it? I mean, if it is available, you might as well make it, right? So in real world, arbitrage cannot exist, and that is precisely why this equation will hold. That is precisely why this equation will hold. That is precisely why the future price can be derived by the spot price multiplied by 1 plus cost of carry raised to the power t. Right? Cost of carry, essentially, at this point of time, our understanding is enough to understand cost of carry in this context. That cost of carry is nothing but the interest rate you're going to pay if you are to borrow that money. The exact opposite will also hold true. So if you had a scenario where future price was less than 1080, if future price was less than 1080, then you would have done exactly the opposite. You would have bought the future. Remember, bought the future means you can buy, let's say the price was at 1060. You can buy Infi shares at 1060 after a year, right? So you need 1060 in your account today, right? So what do? You today your idea changes. Remember, now the future price is the smaller one, the spot price is the greater one, that is the higher one. So you have a higher spot price, which means you sell stock today, get 1000 rupees if you sell the stock, right? There's a concept where you can sell the stock without owning it, which is called as short selling. More on that later. Get 1000, invest at 8%, you get 1080, and then you can execute the contract to buy Infosys at 1060. Then you buy Infi at 1060 at 1060. This Infi share that you have bought, you will give to the guy to whom you had sold this stock. So that stock goes to this guy. That's the delivery of stock, as it is known as. And you had 1080, you bought it at 1060, so you made a riskless profit of 20 here as well. So the exact opposite scene works there as well. So whatever happens, the equation has to zero down on future price is equal to your spot price into 1 plus cost of carry, which is R raised to the power t, right? There are some other adjustments, minor adjustments to this which come, which we will discuss when we talk about futures in the context of derivatives at a later stage. At this point of time, that's not required of us. That's beyond the scope of our discussion. One final thing that we do need to understand is spot futures convergence. Let's understand this two ways. Let's go back to our bet. If I was betting on the price of Infosys shares, and today the price is 1000, and I think it'll go above 1050 in a month, right? So I'm here and the price today is 1000 and I am betting at 1050. So I have, forget what the interest rate is, conceptually we're trying to find out. I have 1 month for this to get executed, right? So I have 1 month where there is a chance that Infosys might go above 1050, right? That's fine. Now, if the bet, however, was for 1 day, so if this is 1050 and this is 1000 and this was 1 day, that's not a feasible bet. Because in one day, the chances of Infosys rising above 1050 are extremely difficult, right? What will I do? I will probably put a price of maybe 1010 because there's a 1% rise, and I'll say that, okay, I can buy Infosys at 1010 if this contract was for tomorrow, right? If the contract was for 1 hour and I was at 1000 right now, and the price of Infosys has to happen, the contract has to get executed after 1 hour, I'll probably pay even lesser, something like 1004 maybe, argument's sake. Why? Is because in 1 hour I don't think it can rise 10 rupees, right? If this was 1 minute, which means basically the contract is going to get executed the next minute, there is no point keeping it at 1050, 1010, 1004 because Infosys is at 1000 today. Most likely I will say that, 1000 is the price I will buy Infosys from you at. There is no point in me betting Infosys moving significantly different away from the spot price if the time is less. So as time t approaches 0, spot price is where I will put the bet, or I will buy the contract closer to the spot price. I can't go away from the spot price, right? Which basically means a couple of things. We will also look at the same point using our equation. We had this discussion on future prices, current price, or spot price into 1 plus r to the power t. As time t approaches 0, this term here becomes 0. The futures price has to become similar because this entire thing will become 1, which means the future price will become equal to the spot price, right? So what we are saying is that if this is the spot and this is the future, as time t approaches towards 0, these prices have to converge. They have to reach the same price point, right? So if spot is 1000 today and future is 1050 today, if at the end spot is at 1020, the future also has to be at 1020 because your equation will become spot price 1020 into 1 plus r to the power 0, which will be equal to 1020, right? So essentially, this principle is known as spot futures price convergence, is again a premise of how riskless money cannot be made in the markets, because if I can buy Infosys at a price different than this, there is riskless money in the market, right? Technically, at this instance, if I can enter, if the Infosys price is at 100, that's the spot price, and the future price is at 1010, I can immediately get into the same kind of a contract, buy this, sell this, and borrow money to buy this. If the contract is expiring next minute, I don't have to pay anything, right? I'll take money from a friend of mine, take 1000 rupees, buy a stock of Infosys, immediately be able to execute this contract, sell the stock of Infosys at 1010, and repay the 1000 rupees to my friend, thereby making 10 rupees in the process, right? So technically, the same no arbitrage principle goes ahead and results in what is called as spot futures price convergence. This is also an important concept in the context of future pricing. That's how we define the price of a future. Remember, there is a cost of carry for carrying that money to the time in the future so that I'm able to execute the contract. That is called as the cost of carry, which is effectively the interest rate in the market. There are other connotations of cost of carry in terms of other kind of commodities. So for example, if I have to sell a future contract on something like cotton, I do need to ensure that I have to deliver cotton after 2 months or 3 months. So there is a storage cost of cotton as well, right? Those elements start coming into the picture, and that's why the pricing of futures gets a little bit more complicated when we discuss multiple assets. But that is beyond the scope at this point of time. We don't need to worry about that right now. Right now, for us, the basic principle that needs to, that we need to take care of is that the future price is a function of the current spot price multiplied by 1 plus cost of carry raised to the power t, right? Thank you.